When you spot an uptrend structure, a powerful signal that the trend is likely to continue, how do you act on it? What's your game plan to turn this insight into profitable trade executions? Let me tell you, normally there are three plans. The worst option is to jump into the trade immediately, assuming the trend will hold. And the best strategy is to wait for a retrace to a high probability order block. And a middle approach is to wait for the price to return to the fair value gap to activate your long order. But here's the surprising part. As we observe, the worst option seems to work better. Familiar, isn't it? However, these are not even close to what we will discuss. In the first part of this video, we will discuss the candle range theory concepts including power of three and AMD to see how to use these concepts to trade candle range theory. In the second part, we will discuss the most practical concepts of market structure to combine them with CRT. This video is designed to be simple for beginners, even though it includes advanced methods. If you come across repeated concepts, be patient. It means you have a deeper understanding of my approach and can apply this method more effectively than a beginner. This education isn't for those who judge or seek quick gains. It's for those committed to becoming profitable. And I'm here to show you a strategy that can make you a consistently profitable trader, but only if you're willing to set aside your current mindset because what I'm teaching might seem wrong and unfamiliar, and at first glance, you might think it contradicts what you've been told. But maybe that's why you're not profitable yet, and I am giving you the missed parts of your success puzzle. So try hard to understand what I'm teaching you, and if you have questions, ask in the comments. I'll personally help. Let's start with the candle range theory. Candle range theory explains that every candlestick has a defined range, and the price can either trade within this range or break out of it. These movements create excellent trading opportunities, especially when the price behaves as expected. These expectations are summarized in the power of three, which highlights that every market movement consists of three key phases: accumulation, manipulation, and distribution. Markets always predictably cycle through these phases. Once the price moves through the accumulation phase and follows with the manipulation phase, it is expected to enter the distribution phase. This cyclical pattern is the foundation of the candle range theory. The cycle completes when the distribution phase occurs, which is directly influenced by the preceding accumulation and manipulation phases. If we can correctly identify these two early phases, we can anticipate the price's transition into the distribution phase, allowing us to look for entry to trade the distribution phase before it happens. Candle range theory includes a pattern-based method that helps identify when the price is more likely to trade within the range rather than sweep beyond it. The accumulation phase, as its name suggests, involves accumulated orders around key levels without a clear direction. Meanwhile, the manipulation phase gives traders a false sense of direction by moving the price to sweep beyond that key level. This induces traders to enter the wrong direction, and then, after trapping traders, the market moves in the true direction, completing the cycle by trading in the distribution phase. It is important to know that the CRT pattern is not limited to just three candles, and it can form by multiple candles. To confirm a valid CRT pattern, we need to see a candle or series of candles surpass the range and then closed inside the range. And if a surpassed candle closes beyond the range, this will not be a CRT valid pattern. While these concepts may sound simple in theory, executing them in practice is challenging, especially for beginners. Many struggle with recognizing these phases accurately, as we have experienced firsthand. Consider this example. Not every candle's range is revisited by the market. In fact, most candles are ignored by the price, while only a select few get retraded. This led us to conduct in-depth research to uncover which candle's range has the higher probability of getting retrade by the market. Previously, we were looking for range candles at key times, 1 a.m., 5 a.m., 9 a.m., 1 p.m., 5 p.m., and 9 p.m., to identify the most disposed range candles to trade CRT. But in this education, I want you to forget the key times, because I will give you a better idea. After testing many concepts and backtesting many methods, the Market Pulse team discovered that the pullback candles are the most suitable candles to consider as the range candles. This is because the nature of pullbacks is to drive the price forward, helping the trend to continue. For example, this is a clear pullback candle, and it represents the CRT pattern we're looking for. This simple idea is the key to becoming a profitable trader, so just focus on understanding this simple method. So what is the pullback candle? Where to find it and how to validate it's a pullback candle? To fully understand this concept, we need to cover the market structure. So, let's discuss the market structure and how it drives every move in the markets. Every candle tells a story through its internal structure and its time period, which includes the open and close, high and low. From the moment a candle opens, price movements shape its high and low before it ultimately closes. The candle's closing price at the end of its time period is the key. It determines whether the candle forms a bullish structure or a bearish structure. The combination of a candle's structure, along with the structures of other candles, especially its preceding and succeeding candles, forms the market's dynamic structure, which includes three main phases: uptrends, downtrends, and consolidation. An uptrend means the market is climbing higher, your signal to focus on buying and ride the momentum. A downtrend is the opposite, a steady fall where selling is your best move. Then there's consolidation, the market's aimless sideways shuffle. It offers little trading potential but hides crucial clues we'll tackle later in the liquidity section. For now, let's zero in on uptrends and downtrends. So how do we identify a trend? It's all about price highs and lows. In an uptrend, the market forms higher highs and higher lows. Each break of structure, where the price surges beyond a previous high, cements the trend's upward momentum. This is what exactly we are talking about. A candle breaks above the previous high, but it doesn't stop there. Each break forms a demand zone, a critical area that keeps the trend intact. For the break to count, a candle must close above the level, not just wick past it. Wicks often signal rejection or a liquidity grab, catching traders off guard. If a full-bodied candle closes above, it confirms the breakout. The last higher low becomes your key level. Stay above it, and the trend remains bullish. This is the last higher low, and until the price is above it, we are still bullish. Once an uptrend is confirmed, every bearish candle that forms thereafter is considered a pullback until it provides confirmation of a breakdown. Every trend boils down to two components: impulsive moves and corrective moves. Impulsive moves drive the trend forward, breaking previous structures. In an uptrend, each impulsive push creates a higher high, while corrective pullbacks form higher lows. These pullbacks don't break the structure, but set the stage for the next impulse. So the pullbacks are forming inside two impulsive moves, which gives us an opportunity to trade candle range theory. So how can we confirm this is just a corrective pullback, and it's not a breakdown? Mastering this concept is like striking gold. The question is, how can we use this knowledge? The time you validate an uptrend, the candle range theory becomes your edge. Here's the idea. Imagine the market is in an uptrend which is confirmed by this break of structure, and we anticipate it's targeting this high. Until we have not confirmed a closed candle below this level and we consider this move just a pullback, we expect the price is likely trading through this area on its way to reaching the high, which makes this bearish candle range a prime trade opportunity. So here we have accumulated short orders, manipulation, and opportunity to go long. When we recognize the manipulation phase, it's crucial to check the lower time frames to identify an order block entry. The order block entry is a key component of our strategy. It's the only entry that completes our method, which confirms that we are following the smart money's footsteps. If we can't identify an entry, it means something went wrong in our analysis. It's important to know without the order block entry, we are not allowed to execute a trade. Now let's get back to the example we started with, to see how to act when we face an uptrend structure. Low, high, higher low, and a break of structure. So here we have a confirmed uptrend, and until the price has not met this demand zone, we will stay bullish. So from this moment, we should consider every bearish candle that appears on the chart a pullback candle until it confirms a breakdown. So we should check all the upcoming bearish candles range for CRT confirmations. The next candle forms bearish, so we can consider it a pullback, but it seems there will be another bearish candle. It is so important to know if you observe more than one bearish candle consistently. To determine the pullback candle as the range candle, you have to go to higher time frames to see those consistent candles as one candle in the market structure confirmations. For example, these two candles will combine to be a 1-hour candle in the 1-hour chart, and we will consider it as the pullback candle. Let's determine its range as the range candle that we are looking to trade its range. We expect to see the price to trade to reach the candle range high, so we should look for manipulation here. To confirm a manipulation phase, we need to see a candle or candles break the determined range with the wick and return to close inside the range. Then I will check lower time frames to see a bullish order block entry, which is the last confirmation of this method. To see the order block entry, we need to go lower time frames. Here's a clear order block in a 3-minute time frame chart. That's it, guys. I am sure you know how to execute a long order. The method to identify this order block is so simple but unique, and no one talks about it yet. It is limited to the Market Pulse team, and we will share it soon. If this video provides valuable information, please like it, subscribe to our channel, and turn on notifications to stay updated with upcoming content.